Hi, everyone. Welcome to today's webinar with Bill Petit and Paul Marshall from MetLife. A couple of housekeeping things before we get started. First off, this webinar will be recorded and will be sent to you guys following the meeting. Second of all, if you have questions, please put them in the Q&A section, which is at the bar at the top. And with that, I'll hand it over to Phil and Paul to get started.
Awesome. Thank you, Mark, and to the Business Exit Planning Group for having us today. My name is Phil Petit. I'm one of the sales directors for the Structured Settlements Division here at MetLife. Just a little bit about me. I've been in the structured settlements industry for more than 16 years, and I've been with MetLife since 2004. And I'm also joined by my colleague, Paul Marshall, who is also a sales director in the Structured Settlements team. And he's been in industry for, I think, 35 years, right, Paul? And at Met since 2005.
Correct.
Yep. So we have an exciting topic that we're going to cover today that is really focused on helping sellers of a long-held asset like a small business. And when you think about this, how many times have you heard someone say that they feel tax trapped, where they are hesitant to sell their business because if they do, they're going to get hit with a huge tax bill, where oftentimes people just they sit on the sidelines and they don't end up selling because they see all that equity that they built over the years being effectively eroded away. So that's where we feel like we have a solution for you to really add to your toolkit and to help in these types of scenarios and really help your clients exit their business in a tax efficient manner where they can defer and potentially reduce and save some taxes. And ultimately, at the end of the day, keep more of their sales proceeds. So with that, this is just want to move to our agenda for today. And really the main point we want you to walk away with today is the tax efficient advantages of periodic payments versus a lump sum or cash transaction when selling, whether that be a business, a commercial property, or even real estate for that matter. So the specific concept that we're focused on today is called a structured installment sale. So Paul and I thought it'd be helpful to let's give you the lay of the land to help you gain a better understanding of how this concept works, what it is, and how it can fit into your client's financial strategy, including their retirement plan. Then I'm going to turn it all to Paul, and I like to say he gets all the fun slides, which he's going to take you through a case example of a client that was actually able to defer and save on taxes. And then we're going to pivot a little bit, and we're going to share some other practical examples. And we want to do that just to show you really the breadth of the product. But I just want to mention, don't limit yourself to just the case types that we're going through, because there's many other business types of cases that we'll go through, and I'll give you some more examples. But just we're sharing these as just some examples to help you get the idea of where this solution can be used. And then we're going to run through the mechanics of how one of these works. We'll share some frequently asked questions, and then we'll take a look at your role in the process and how you can help. So we have enough content to get us to the hour. And again, please there's the Q&A feature on your toolbar on the top. Use that to ask questions. And then at the end, we're going to have ample time to go through some Q&A at the end. So with that, what is a structured installment sale? All righty, so here we go. So clients can protect their business sale proceeds and guaranteed income with periodic payments. Now, before we dive into what a structured installment sale is, I just want to take a minute and walk you through what an installment sale is before we get to the structure that MetLife provides. So this idea that a seller can negotiate for and receive payments over time and also pay their taxes over time via the installment method of tax reporting has been around since 1954. And this is when Congress enacted the Revenue Act of 1954, coincidentally. Now, if this concept sounds familiar to you, you've probably heard or maybe you've even been involved in a deal where there's what's known as seller financing or a carryback note. Now, seller financing is a traditional installment sale. So this idea of an installment sale in the traditional sense, now this is not an idea from MetLife that we reintroduced to market back in 2020, but that term or that concept structured installment sale is. Now, Paul and I get asked this question quite frequently. People are always like, hey, why haven't I heard about this product before? And it's a relatively simple answer. It's relatively new offering. So MetLife has taken this time-tested, well-vetted idea that is really the foundation that we've built for our product. And with that, if you think about this concept or even installment sale, so any taxpayer, they can take an appreciated property, right, and sell it today to a buyer, and they can be paid out over time. This is fine. The IRS is completely on board with this. However, in utilizing this particular method, the seller is subject to the financial creditworthiness of the buyer. So let's say a buyer purchases your business and God forbid they run the firm into the ground. Maybe you don't get that fourth or that fifth installment payment like you as the seller planned. Now, I could sell my business to Paul right now and he could pay me over time. And I would only pay taxes as I receive the funds because I use cash-based accounting for my taxes. Now, Paul and I think we've known each other close to 20 years. We're friends. He was at my wedding, so we go way back. But when you think about where MetLife's value proposition comes in is why would I want to be exposed to Paul's credit risk? No offense to my friend Paul, but if I could get a strong financial entity like MetLife, who manages billions upon billions of clients' money and has been doing so since the Civil War, then that's what I would probably choose. And when you start to think about it, is that what any client should choose? And at a minimum, is that what any prudent advisor should at least make their seller aware of? So that way they can make the decision in conjunction with the buyer. And this is really where a structured installment sale, this solution is really gaining a lot of popularity because sellers really want to take the buyer's credit risk out of the equation. So, really at its core, a structured installment sale, it's simply an IRS Section 453 installment sale with an extra layer of protection, right? That's the way I like to think about it. Now, with the structured installment sale, we are focused on Internal Revenue Code Section 453. This is the tax code that governs the product. This is what we hang our hat on. This is the tax code that very clearly defines what is eligible as well as what's not eligible under an installment sale transaction. In fact, the code reads, I have it right here, the term installment sale means a disposition of property where at least one payment is to receive after the close of the taxable year in which the disposition occurs. Now, what this means is that a seller of a business or a property leveraging the installment sale method can defer taxes by receiving payments over time and only paying tax when payments are received. So, and that's even the case if the sale occurred in a prior year. So as long as at least one payment is received after the tax year in which the sale occurs, this can occur. And that's important, right? This is an important concept about at least one payment happening after the tax year in which the sale occurs that is an important component of the transaction that all the parties need to be aware of, which is the timing of when the payments need to be made. So just bear that in mind. So with that, so now we're building off the traditional installment sale between buyer and seller, and we MetLife, what's our role? We're stepping into the middle of the transaction, and we are acting as what's known as a substitute obligor. So when doing this, the seller now has comfort knowing that a strong carrier like MetLife is there to guarantee the payments, as opposed to a traditional installment sale where the seller has to rely on that financial creditworthiness of the buyer, which oftentimes is not ideal. And so now one of the key distinctions between a traditional installment sale and a structured installment sale is that the buyer, they got to have the funds. So they either have to have cash on hand or they have to obtain loan to fund the future payment obligation. So in the business context, that could be an SBA loan to ultimately transfer that payment obligation to MetLife at closing. And really at the end of the day, if you think about this concept, structured installment sale, this is a negotiation tool. And this is a concept that needs to be presented before an offer is accepted. That's key. And I've seen, unfortunately, too many opportunities flounder because this concept was brought up at the last minute. So like the 11th hour, like a week before closing. So, timing is really everything in one of these, especially if this is the seller is looking to do this, because you got to get the buyer engagement to do a properly done structured installment sale. So, all right, so moving on, what sales are ineligible? All right, so IRC Section 453 provides a pretty broad guidance or broad set of properties that are eligible and for sales that are not eligible. Now, an important concept to keep in mind is that in order for a structured installment sale to be successfully implemented, the property or the asset that's being sold must first qualify for installment sale tax treatment as outlined in IRS Publication 537. So I like to think of IRS Publication 537. This is really your encyclopedia, right, for everything installment sale related. So a very important document to familiarize yourself with and one to have in your back pocket. All right, so let's spend a moment and look at a few of the specific categories that you should be mindful of that are ineligible. So for starters, if the business has depreciated property, that would not be eligible, like a forklift, for example. Any of the depreciated real estate as well. Also, plant and equipment is generally not eligible. Its inventory is not eligible. If you have shares of a firm that are traded on an established market, those are not eligible. Now, privately held shares are okay. And for individuals selling a business where there's depreciation recapture, that's not eligible as well. Also, I do want to add, if you have depreciable property between related persons, now there are certain exceptions provided under IRC 453, but generally speaking, this is not permitted. And there's actually a last item that's not listed, is that the installment method does not apply to sales that result in a loss. So again, these are just some items to keep in mind as you're thinking through a specific opportunity you have. But the IRS, they never say anything 100%. There's always an exception in there or two for its rules. And again, IRS Publication 537 is a good resource that can help give you direction and help determine what is eligible and what is not eligible. So, all right, so moving on. So we already know IRC Section 453 is very broad with some very narrow exceptions, as we just covered. But MetLife also has its own rules. First and foremost, we are only looking for sales where the capital gain is greater than $500,000. And this is really the sweet spot for both the client to begin taking advantage of the capital gains taxes and really for MetLife to provide the most efficient product. Now, I do want to add that it's not an all or nothing deal. So the seller does not have to put the entire property or business sale amount into the structured installment sale. In fact, it's very common that we see typically it's a portion of those assets that are allocated to the structured installment sale, and then the seller will take cash for the remaining piece or utilize another strategy if they like. And then if you think about what this product is specifically designed for, this is really designed for small businesses, real estate, agriculture, for residential, commercial properties. For this group, business obviously eligible. I would state, not knowing any of your clientele list, they're better business targets. Really awareness is key in this space. So you don't want to leave any stone unturned, but more your capital intensive businesses. So an extreme example, like a mining operation, or even an automated warehouse or a manufacturer for that matter, will have less of the sales price eligible. And the reason is that the installment sale method in general is targeting the capital or the intangible value of the firm. So think of your goodwill, your client list, your intellectual property. Um, so just think of your Main Street businesses. You know, you're walking down Main Street, right? You have a dentist office, you know, great, unless it's equipment. If you have a real estate firm, even better, unless it's computers. If you have a financial or insurance firm, you know, those are like prime. Like that's awesome. Like that's one that has very, very little, um, it's very capital light, as I like to say. But again, as I was describing earlier, if the business has depreciated property like the forklift, that's not eligible, or depreciated real estate as well, or inventory, not eligible. So just again, some things to keep in mind. So one more comment I want to make on the business front is think of a small business owner. They're very, very successful. They put their blood, sweat, and tears into the business. Typically, they're not getting a pension or they don't have a 401k. And when they go to retire, all that value that they've worked for decades for, typically, not always, but they've worked a very, very long time, is locked up in that business. And what a great way to take all or a portion of that hard-earned work and turn it into a tax-efficient, guaranteed stream of income. So that's really where we're seeing the light bulb go off with folks that kind of fit that small business owner category. Now, I do want to make one quick comment on real estate or residences. So as your business owners are transitioning to retirement, perhaps they're also thinking about downsizing their home. American homes are one of the largest retirement assets that people have, and we don't want you to forget that as you're helping your clients plan their exit. So if you think about it, perhaps they can withhold liquidating other assets that might be more illiquid that don't have the tax efficiency. So this could be part of that more holistic financial strategy. So just something to keep in mind. And then the last point I want to make on this slide is the product availability. So we're available in all 50 states, including DC, Puerto Rico. We actually just had in New York about a month or so ago. So we're now nationwide for the product, which is really exciting for us. All righty, so what are the benefits of structuring? So I don't want to sound like a broken record, but the installment sale method exists outside of MetLife. So your client can sell to Denise the dentist or Ray the realtor, and they can have those folks make payments over time. Now, the team that's marketing structured installment sales, so myself, Paul, the sales team, our product team, we cut our teeth in the personal injury market, solving complex litigation cases that offer a win-win for both plaintiff and defense. And when you think about a structured installment sale, there's actually really a lot of synergies between the two products. So even litigation and business sales are very different. At the end of the day, this concept is used as a negotiation tool. And the mechanics of the product act very similar between the two concepts. And Paul is actually going to go into greater detail here shortly to go through the various components of the transaction, specifically the assignment transaction, and how that's accomplished and what the buyer, what they're doing. But ultimately, we're here to raise awareness, right, of the win-wins for your sellers and the purchasers. And the sellers' wins, they're listed, right? They get dependable income from a partner they can trust. That is what MetLife has done and will continue to do for its clients and the billions upon billions of assets that we manage for them. However, this product is not a grand slam. It's not really an investment. We pay what the client has bargained for, and it's the start of a financial plan. So, this is not going to turn out to be the next tech or meme stock, or speculative investment. This is the seller's transition to a retirement paycheck that will provide guaranteed income, plain and simple. Second, with the correct set of circumstances, the seller can have a more tax-efficient outcome using a structured installment sale. And the reason for this is because the cash flows are spread out over future tax years. So think about this. So instead of a seller selling their business today and getting one large check, the seller is actually going to receive payments over time that are spread out over the future years, which defers and potentially reduces cap gains tax as well as net investment income tax. And Paul is going to walk you through a case example here in a minute to show you an individual that was able to accomplish just that. Now, I'm sure you're all aware there's tax brackets for cap gains. So since 2017 Tax Cut and Jobs Act, there's 3 brackets plus a possible net investment income tax. So just on the married side of things, of capital gains, and of course, single, the levels are different, but let's just go through married for a second. So if you have income between 0 and 96,700, there's no capital gains tax. Whereas if your income falls between 96,701 and 600,050, that's where you're in the 15% bracket. And then if your income is 600,051 and above, that's when you're up in the 20%, which is the maximum bracket. Plus, you have an additional 3.8% net investment income tax if your modified gross income eclipses that $250,000 mark. And of course, there's certain state taxes that can be applied as well. So I think all of you are probably more than aware, or well aware than you'd like, but we have a progressive income tax system. So that's something that your clients have to contend with, is that progressive capital gains tax and potentially progressive state income taxes in certain states. So if you're able to move from one cap gain bracket down to the next, that could result in a significant tax savings, which at the end of the day, that means more in the seller's pocket, right? Now, that's the seller. So looking over to the buyer has different wins. First, transfer risk. Simple story I've been telling all along. The risk of making the payments are shifted to MetLife no matter what happens to the buyer, right? So if they run that business in the ground or they're not able to make payments, that doesn't affect the seller, right? The seller still gets the payments. No matter what, MetLife pays. Financial crisis happens, we paid. Global pandemic ensues, we paid. We deliver on our promise we've made to our customers, no matter what the circumstances are. The next, MetLife is really good at admin. We make sure we do the correct reporting, the money goes where it needs to go, and if necessary, beneficiaries are paid in a timely manner. And just lastly, the 2 points I want to hit here is that this is a very unique opportunity for a buyer to win a business. So entering in, and what I mean here is a buyer entering into this transaction type can really set them apart by differentiating their offer, right? Or it can allow them room to negotiate and even get a discount on the purchase price. And so Paul, I don't want to steal Paul's thunder, but he's going to share a practical example of someone who successfully used this strategy in a moment. But keep that in mind. But really, if you think about MetLife's value add, what is it? It's the strong credit rating to make the periodic payments more attractive to the seller and the buyer. It is important to note the buyer gets clean title. Once they've signed the documents for memorializing the structured installment sale, they're free to use the property or the business or even sell it again as they want. It's a clean transaction that's accomplished at the close of escrow. That's really an extension of that normal closing process. So, all righty. So tax efficient strategy. All right. So I promised you, Paul, and now he's up. He's going to walk us through some of the pragmatics of how a sale can be done to meet your client's financial goals in a tax efficient manner. So without further ado, here's Paul.
All right. Thank you, Phil. And thank you, everyone, for joining us today. We really appreciate your time. And with that, what we'll do, as Phil had mentioned, is I'll jump into some case examples. But the first one we're going to start with is really from the seller's perspective. And it pertains to the sale of a small business. So with that, Phil, could you flip to the next slide, please? Okay, and one of the types of businesses that Phil mentioned was a dental practice, and this just ironically happens to be a dental practice. So what we have here is we have a situation where Jose is a dentist who owns a major dental practice in California, and he's selling his business for $2.5 million. and he wants to use the sale proceeds from his business to fund his retirement. So he's considering two options in this instance. He's considering selling it for a cash lump sum, and alternatively, a structured installment sale. So with that, there's always assumptions that need to go into these case examples. So for Jose's examples, let's start with the adjusted basis. So the adjusted basis in Jose's business is $1 million. His selling expense is $50,000. So what that's going to equal is a gain of $1.45 million. So what that is that's the $2.5 million sales price minus the $1,050,000, the adjusted basis and the selling expense. So he's looking at a pretty significant gain there, 1.45 million. And also importantly, his filing status is married filing jointly. And the state, the applicable state here is California. Both the business and where Jose reside are California. And lastly, there's no mortgage on the dental practice property. So with that, why don't we jump, Phil, into the next slide with all the numbers. This is where, like Phil said, this is where it gets fun. So the first column that I want to go through is on the left side. So where Jose is considering selling for a lump sum. So if he does, keep in mind, he's got a gain of 1.45 million. So that's a significant gain. That's going to be, as Phil mentioned, he's married filing jointly. So that's going to be taxed at 0, 15, and 20%, the graduated tax brackets. So a big chunk of his gain is going to be at 20%. Hence, he's not shy from paying $250,000 in capital gains taxes. He's paying $239,493 in this instance. In addition to that, Phil had mentioned that the net investment income tax can apply too. And keep in mind, that's the 3.8% tax that applies over a certain threshold. And again, his status is married filing jointly, so that threshold is $250,000. So what that means in terms of net investment income tax, you take the gain, 1.45 million, minus the threshold amount, the 250,000. So that means he's paying 3.8% tax on the 1.2 million, the remainder. So that's another $45,600. Not insignificant. And then lastly, as Phil said, is state income taxes can apply as well. And as you know, California not only has a high state income tax, but it's a graduated state income tax depending on the income level. So here, if he sells it for 2.5 million cash, based on 2024 tax rates of California, state tax rates, he's paying also another $141,140 in California state income tax for a grand total of $426,233 in taxes. So what he's doing is right off the bat, he's losing a good chunk of his money to taxes. His 2.5 million dissipates into $2,073,767 if he sells it for a lump sum today. Now let's take a look on the right side, a structured installment sale. And this is what he opts to do. So we've actually got some real numbers here where what he opted for is he opted to take 0 down at the close. He didn't need any front cash. He didn't need any liquidity. And he wanted a 20-year guaranteed payout. So what that amounted to, the annuity that would pay him is going to pay $191,755 per year for 20 years. So remember, the annuity cost is $2.5 million, but it actually pays out a total of $3,835,100. So $3,835,100. So what that means, that's an internal rate of return of 4.51%. That means that the interest portion over those 20 years is going to be a little bit over 1.3 million. So his 2.5 million that gets put into the annuity ends up paying out over 3.8 million. So broken down on a yearly basis, that would be $66,755 in interest per year, and that is taxed as ordinary income. And I'll talk more about the breaking down of the taxation of an installment sale and specifically a structured installment sale shortly. But what I want to do is go through on the right column. Let's take a look at how this stacks up compared to if Jose sold it for a cash lump sum. So first of all, take a look at the estimated federal income taxes. He's paying only $116,380 over the 20 years instead of the $239,000 and change if he sold it for a lump sum today. So that breaks down to $5,819 per year times 20 years. And what we're doing is we're projecting this out using 2025 federal tax rates. So, because obviously we don't know what they're going to be in the future, but that's what we're using for assumption purposes. So a significant savings there in terms of the federal income taxes. Then, if you look at the next category, the net investment income tax, another huge savings. He's not paying anything. And remember, that's because now Jose's taking this money over 20 years. So he's not exceeding the $250,000 threshold on an annual basis. He's keeping his income below that. So he pays nothing in net investment income tax. So there is another savings of $45,600. And then lastly, as you can see, there's a savings of California state income tax as well. And the reason why is because, again, California has a graduated state income tax depending on the income level, but he's keeping his income level lower by spreading out his payments. So what that amounts to, and that's again based on 2024 California state tax rates, it's $6,061 per year over times 20 years, over 20 years. So that grand total is $121,220. And in total, he's paying, by doing a structured installment sale over 20 years in this example, he's paying a total of $237,600 in taxes. And what that amounts to is a savings of $188,633. So that's a little shy of $200,000 in tax savings by doing this. Plus, keep in mind, he's not just getting 2.5 million out of it. He's getting over 3.8 million when you factor in what the total annuity guaranteed payments are over the 20 years. So certainly a win-win for Jose. All right, with that, Phil, I say we flip to the next slide. Because as Phil mentioned, we're going to go through some practical examples now. And Jose's was really the one that gives all the quantification of the tax savings, et cetera. But these are interesting because some are the buyer's perspective and some are the seller's perspective. So this one pertains to gas stations. So this is the business that's being sold. It's gas stations. But what's happening here, we're looking at from the buyer's perspective. Jane is looking to buy multiple regional gas stations in Texas. And her objectives are, and really what she's questioning is, how can she actually strike a deal to purchase these gas stations? She wants to be able to provide an attractive offer, but she also needs to differentiate her offer because she's facing a lot of competition because there's other potential buyers for these gas stations in Texas. So what she considers are two options. She knows that there are advantages to the seller if she offers a solution with future periodic payments. But the first option that she considers is what Phil termed as seller financing. That's a traditional installment sale where the buyer is just going to make those payments to the seller in the future. There's no MetLife involvement in that situation. But the problem is Jane will have to come up with those future cash flows and those future payments. And the big problem, the challenge is, what if she doesn't? So that subjects the seller to some risk in that instance. So obviously, option B is the better approach, the structured installment sale, because what's happening in that situation, it's much more secure because Met Tower Life is making the periodic payments. instead of Jane. So a huge difference in terms of the seller's perspective on doing this type of a transaction. So at the end of the day, what happens is Jane quickly realized that she would need to do a structured installment sale, not seller financing, because the seller was much more comfortable receiving the future payments from MetLife than from Jane. And at the end of the day, the seller did choose Jane's offer, even though it was lower than some of the other potential buyers, because once the seller and the CPA realized the potential tax savings by receiving the periodic payments versus the lump sum and the security that MetLife provided, that sealed the deal in this instance. All right. So the next one, and like Phil said, we've seen so many different types of examples of business and property sales that don't just limit it to these types of sales, but we had to come up with a few just for this presentation. So the second one would be, as Phil had mentioned, these are great opportunities for a structured installment sale, a financial advisory firm. And as you can see, what we have in this is we have Tim and Peggy, they're both 62, and they owned a financial advisory firm in Oregon. And what they're doing is they're looking for a tax efficient exit strategy and a means to supplement their income once they no longer own the business to provide those cash flows. So in this instance, they consider what really is the strategy and how do they want to go forward with the sale. So what Tim and Peggy did is they made the structured installment sale, in this case, a condition of the offer. And as a result of that, the buyer who ended up buying their firm was able to negotiate a better purchase price. So really, it's a win-win. That's what Phil had mentioned. This is really bridging the gap between the buyer and the seller. And, it may motivate the seller to sell, and the buyer may, they may be able to get a better purchase or a better purchase price as a result. So in this situation, the seller was motivated by the tax savings and the guaranteed income, and the buyer was able to buy the business for less money as a result of offering this solution. So in this case, what happened was zero, kind of similar to Jose, zero was paid to Tim and Peggy at the close, so no cash up front. And then Tim opted for the annuity, paying $115,000 annually for 10 years guaranteed, beginning 3 months after the closing. And what Peggy did is she elected the same payment stream as Tim, and they named each other as their beneficiaries. So that way, if Tim, for example, would die before the 10 years of guaranteed payments paid out, Peggy would receive those remaining 10 years of guaranteed payments directly, and vice versa. So the annuity in this case cost approximately $2 million and paid out approximately $2.3 million. So again, that was a great example of a win-win for both Peggy and Tim, but also the buyer. All right, Phil. So we'll go now. This one's the last one of the examples before I talk a little bit about how it works in FAQs. So this one is a clothing store. Again, another type of example of a business sale. And in this instance, Sarah, who was 40, was selling a clothing store in California and moving to Minnesota for a lifestyle change. So she wanted a solution to replace her income that the business was generating. So what she did is she replaced her income with an 8-year structured installment sale payout. And as Phil mentioned, even though there's ongoing guaranteed payments, the buyer still received title and full ownership of the property at the closing. So that's the beauty of it. There's really no strings attached after the transaction is done, but the seller gets the benefit from having those ongoing guaranteed payments. And unlike Jose and Tim and Peggy, who elected no money at the close, no front cash, Sarah did opt for some money. She wanted a chunk of cash for her move and to get started in Minnesota. So she took $1.3 million in cash, and then she elected for the annuity to pay $13,100 monthly, guaranteed for 8 years, beginning 9 months after the close. So the annuity cost in her situation was approximately $1 million. and it paid out slightly over $1.25 million. All right. Okay, so we'll flip ahead. So as Phil said, that we would also get into a little bit of detail about how one of these transactions works, because it's not just something that's done in a vacuum with the buyer in MetLife or the seller in MetLife. It actually takes the cooperation of all three parties. But what would happen is, for starters, is the buyer and the seller, as you can see between the top two boxes, they're going to agree to sell the business or property and enter into a purchase and sale agreement. Then they're going to execute a purchase and sale agreement addendum. And what that addendum is going to do is it's going to list out what is the cash component, if applicable, upfront cash, and what are the future guaranteed periodic payments. So keep in mind what that purchase and sale addendum is going to say in Jose's case is going to be saying zero paid in cash at the time of the close to Jose. And then for 20 years guaranteed, Jose is going to receive $191,755 per year. So remember, that was the amount that Jose elected and was able to receive in his transaction. So then, very importantly, what happens then is the buyer then assigns that liability to make those future periodic payments to MetLife Assignment Company, Inc. And critically important, the buyer has to send that premium, that in Jose's case, that 2.5 million, directly to MetLife Assignment Company, Inc. The buyer can't send that directly to the seller. Obviously, there would be constructive receipt, actual receipt. It would be problematic from a tax standpoint. So the money has to come directly to MetLife. And then what happens is MetLife Assignment Company then, in turn, purchases and owns an annuity from Metropolitan Tower Life Insurance Company. And keep in mind, both of these companies are US-based entities at MetLife. And then what happens is Met Tower Life, the annuity issuer, is then going to pay the seller. So what happens is that there's an annuity contract that is paying Jose, in his example, $191,755 per year, guaranteed for 20 years. So that's just a quick diagram of the way the transaction would work. All right, so let's go to the FAQs, because we just had a few. We actually have a document that has several more, but we just thought, for purposes of today, let's just select a few that might be of interest, because these are types of questions that often come up, when we're discussing these with potential parties. So the first is, people always want to know, what are the terms of the annuity? Keep in mind, these are guaranteed fixed annuities. So these are not variable products. Once the payments are locked in and purchased, they cannot change. But that's the beauty of it. No matter what happens to the economy or to the buyer, the seller knows exactly what they're going to be receiving from MetLife. So generally speaking, though, the longest that we could offer guaranteed payments would be 40 years, and that's contingent upon certain factors. But I want you also, because this question comes up too, well, what's the minimum? And that depends, but it could be as few as 13 months if they're monthly payments, and it could be as few as 4 years if the payments are set annual, semi-annual, or quarterly. But one other thing that comes up too with respect to payments, people oftentimes will ask, well, can I defer payments? Like, I'm 50 and can I receive a balloon payment at 65? The answer would be no, not with MetLife's product, because these payments, they must generally start within a year, be substantially equal, and at least annual. So what that means is there's no lump sums or deferrals. This is just going to be guaranteed income that's very steady, which oftentimes is really just what people want. If they're looking for retirement income or replacing the business cash flows, what have you, they want that steady income oftentimes. So number two, because this question comes up quite a bit, is what happens to the structured installment sale payments at death? And I mentioned it with Tim and Peggy, alluded to it, is keep in mind these are guaranteed payments. So say, for example, in their case, if one would die within the guarantee period, the remainder would be paid to the named beneficiary or to the estate if the seller doesn't name a beneficiary as they fall due. So if there's 5 years, if there's 10 years of guaranteed payments due and the seller passes after 5 years, the remaining 5 years would be payable as they are due. And there is also a commutation endorsement feature, but it would have to be elected by the seller at the time that the documents are signed. But that would give some liquidity to a beneficiary if that's something that's desired. Okay. So thirdly and lastly, what does an installment sale payment consist of? And you can see we've got the 3 items broken out there. But I always like to start with the middle one because that's the one that's not taxed. The return of the adjusted basis is the portion that's not taxed. And then, of course, the gain on the sale is going to be taxed as capital gains. And then lastly, the interest portion is going to be taxed as ordinary income. And I think something that's important too to know is that when an installment sale or a structured installment sale are done, this has to be reported. So let's back up a moment. Let's say it's a structured installment sale. MetLife is going to require upfront that the seller complete an IRS form W-9 and W-4P. And that's for tax reporting and withholding purposes so that we know exactly what to do with respect to reporting and withholding. Then we're going to issue an IRS form 1099-B annually to the seller. And that 1099-B is going to just list the gross proceeds that we paid to the seller in that year. Then what happens, and this is whether it's a structured installment sale with MetLife or an installment sale between the buyer and seller, is the seller has to complete annually an IRS form 6252, and that pertains to installment sale income. And that's where they and their accountant would break it all out in terms of the portions. What's going to be the return of basis that's not taxed, what's going to be the gain that's taxed as capital gains, and what portion is interest that's going to be taxed as ordinary income. So that is it in a nutshell. So I think what we can do, we wanted to make sure that we save some time for Q&A, but really, as Phil mentioned from the outset, really what's your role and how can you help? Really, the purpose of today is to make you aware of this product, this solution that's really can be a win-win to help you not only expand your toolkit, but help bridge the gap between the buyer and the seller by providing a unique solution that just may get the deal done in a manner that's favorable to both the buyer and the seller. So with that, Phil, I think why don't we, if you had a chance maybe to take a look and see if there's any questions that have come up.
Yeah, we got a few questions on the Q&A and actually a couple on the chat. Just a reminder, folks, please use the Q&A for the chat feature, but I'm going to go through the Q&A ones first, and then we'll jump back to the chat feature. But no, for starters, we got a question. Can a structured installment sale be used with a foreign buyer or seller? So Paul, I'll take a stab at that one. So for a structured installment sale, our underwriting guidelines, we require that both the buyer and the seller be U.S. citizens. And the reason for that is, well, from the buyer's side of things, we have to do, there's a suitability and a compliance piece of this product. So for the buyer, we have to do a source of funds document where we have to do our due diligence, we have to do our anti-money laundering, our OFAC check. So as of today, we're only permitting U.S. or U.S. citizens as buyer. And similarly, on the seller side, because this is a taxable product, we require that the seller also be a U.S. citizen. So those are the requirements that both buyer and seller have to be a U.S. citizen. So unfortunately, no foreign buyers today. Next question from Chris. Does the IRS charge interest on the deferred tax liability? Well, you want to take that, or you want me to take a stab?
Yeah, I'll take that. In terms of the interest on the deferred tax liability, it may, And the answer is it really depends in terms of the what the installment sale pertains to, the structured installment sale, and what is the size of it. But basically, what happens is the if generally speaking, the seller must pay interest on the deferred tax if the installment sale obligations are greater than 5 million. So it would be a sizable sale for starters. It doesn't apply to everything. And then on top of it, like always, there's exceptions under the Internal Revenue Code. And one of them is personal use property, and another would be trade or business related to farming. So yeah, that's a good question. And the answer is it may, but it's all case by case.
Oh, great, Paul. Thank you.
Yep.
All right, next one. This is from an anonymous. Thanks, Paul. Interesting. How can I learn more about this? Anyone I should reach out to? Yeah, so I'd say for starters, so MetLife, we have a dedicated website for the product. I would go into Google and type in MetLife Structured Installment Sales. It'll take you right to our landing page. So we have a wealth of information there, including a white paper that's a great primer for the product that really gets into the mechanics of how the product works. Similarly, there's some videos and slip sheets for sellers and for buyers. So just a good resource to learn more. And then, of course, on the screen, this is Paul and my contact information. So you can always feel free to email us or give us a call. We're happy to talk through whether you have a specific opportunity at hand or if you just want to talk more general. Just if you had any further questions on how the product works, we're happy to do that. All right, I'm gonna, as I promised, gonna move to the chat and then I'll go back to the Q&A. But for the chat, there's a question from Michael that says, does the buyer have to pay the entire purchase price at closing to MetLife, or can they make installment payments to MetLife without affecting the guaranteed annual annuity amount to the seller? So I'll take that one, Paul. So Michael, yeah, so the buyer, they have to send to MetLife essentially what the present value is of those future installment payments or those future periodic payments. And if you recall from what Paul and I mentioned earlier, it doesn't have to be the entire amount. It can be just a portion of that. Because remember, some components of an installment transaction aren't eligible, like the inventory example, or if you had depreciation recapture. And of course, it's at the seller's discretion in conjunction with what they're doing with the buyer, what they're ultimately agreeing to. But yeah, the buyer has to make that single payment that essentially purchases those future payments, and that money has to come directly from the buyer to MetLife. And that's very purposeful. That's following that diagram that Paul showed, which is the assignment mechanism and kind of the choreographed steps that have to be followed in order for the seller to realize the deferral and potential savings on taxes. And then next we have a question from Eric. So does this mean MetLife has to adjudicate the risk of the buyer and turn potentially affect the price? Eric, I'm not sure I'm following the adjudicate piece. Maybe we can take that offline. So feel free to reach out to me and we can talk through that one further. And happy to discuss that one.
Well, and Phil, I'll throw something in though, and depending on really what the nature of the question is the risk of the transaction. We make no representations. MetLife doesn't with respect to what is being sold, the property or the business. The only thing that we're doing is we're pricing out the annuity. So regardless of what risk factors may or may not exist between the buyer and the seller, the annuity is objectively priced based on certain factors, including prevailing interest rates, underlying investments, et cetera. So, I mean, I think that would be my quick take, but if that's not really where the question was going, yeah, just let us know offline.
Yeah, thank you, Paul. And yeah, just to add to that, Eric, so, our MetLife's only responsibility is those future periods. So if that purchase and sale agreement goes bust, that's not a MetLife, right? Because we have no say in that. Like, we're not a party to the transaction. We're not taking title. It's a clean transition, so the buyer gets the title at close. So yeah, just keep those in mind. Actually, we have another. Right, so I'm going to go back to the Q&A. Hold on, we have another from Anonymous. Here we go. Let's see. Thank you both. Will you be at the upcoming BI conference? Actually, yes, I will. In 2 weeks, I will be at the BEI conference. So, if you have any further questions or you're happy to be there, feel free to stop by, say hello, or I'm happy to have further dialogue and we can discuss how the product works and where we're seeing success and where opportunity is. So, happy to meet any folks that happen to be there. See, there was another one. Is there another question on the Q&A? What does the ideal client look like for structured installment sales? Well, I would say, just going back to, if we're talking in the business context, specifically for this group, it's the capital light type businesses. It's a seller that, owns a business that, it's a service related businesses, for example, maybe at or close to retirement, looking to supplement their income and looking to do it in a tax efficient way. Paul went through some great practical examples. It's not mutually exclusive to retirees. We had that one example of the 40-year-old selling the clothing store, and we've seen younger individuals as well leverage this product. But I would say more times than not, it tends to be more the baby boomer type generation that's looking to supplement their retirement income in a tax efficient manner. I don't know, Paul, anything else to add to that?
No, you covered it very thoroughly.
Perfect. All right. Just checking on the Q&A to see if we have any more questions. Actually, looks like another question popped up on the chat. How does this is from Michael, how does this product reduce the seller's payment risk if the seller has to pay the amount to MetLife, which it could pay to the buyer? Well, so Michael, the buyer is the one who's actually sending the purchase to the money to MetLife, because the seller has the money, it's too late to do this, because that's where you have actually an economic benefit or actual receipt. And the way the transaction is memorialized is that you're doing it in a manner, and again, going back to that transaction or that diagram Paul went through, you're avoiding any economic benefit or constructive receipt. And it's very important to keep in mind that the seller, they're not the owner of the annuity. It's the assignment company. So for our purposes, MetLife Assignment Company, Inc. And that's very purposeful, because if the seller was the owner, that's where you'd have that economic benefit or the constructive receipt. And that's where the seller would not have what the intention is to defer and possibly save on taxes. So, it's not that it's that the seller is paying it, but the buyer is doing it. And the way it's reducing the risk to the seller is that it's removing that that greatest risk that exists in a traditional installment sale or seller financing, which is the risk of the buyer defaulting. You're taking that individual person, you're taking that credit risk out of the equation and substituting that with a 155-year-old plus company that has some of the highest financial strength ratings, very well capitalized, and very diverse investment portfolio to help deliver on the promise and make those future payments. So I hope that answers your question. And I'm just going to flip back to the Q&A to see if we have any more questions. So we have a question from Steve. Hold on. Assume a large goodwill sale of 6 to 8 million. Can some property be received in advance and the balance over time? So I guess, and I'm going to take a stab at this. And so I'm thinking that the question is around if they're selling a portion of it now and maybe a portion later. Paul, let me read that. So assuming a large goodwill sale, 6 to 8 million, can some property be received in advance? So, I mean, they again, it's not an all or nothing. Like, they can take a portion of the sales proceeds at cash at close. So let's say in this example, it's 6 million, right? They can take $1 million cash and close and put 5 million into the installment sale. So you're right under that deferred interest penalty, with this 5 million or 501 million and above. So there is that flexibility. Now, in terms of, yes, you can take payments over time, but if the sale happens today, you can at a future date do another structured installment sale typically. So that would just be the only caveat I would add to that. So, all right. So it looks like we're at time. Looks like we've covered all the Q&A. Again, just want to say thank you to everyone for taking the time. Again, this is Paul, and my contact information is up here. Feel free to reach out to us if you have any questions, or if you have a live hot opportunity you'd like to discuss. And of course, those of you that are going to the BI conference in Denver in a couple of weeks, I will be there. And again, feel free to stop by and say hello. So, all right. Well, thank you, everyone, and enjoy the rest of your day.
Thanks, everyone. Have a great afternoon.